My name is Gemma Yates. I am the Investor Engagement Lead at ACCR. I'll be hosting today's webinar. Before we get started, I would like to acknowledge the Gadigal people of the Eora Nation, who are the traditional custodians of the land that I am dialing in from today. I'd like to pay my respects to elders, both past and present. Today, we will be covering the members' statement that ACCR has filed with Santos, outlining why we will be voting against the Santos chair, Keith Spence. We'll also have time to discuss the recent analysis that we have published on Santos's growth portfolio. So, Alex, over to you.
Hello, everyone. So today, we'll go through why we're intending to vote against the chair, Keith Spence, a fairly detailed analysis of the financial performance of Santos, a quick look at the remuneration settings and some governance concerns, and then look at the other directors or the full suite of directors up for election and re-election this year. And then something relatively new is some research into Santos's growth portfolio. So starting with the member statement that we filed against Keith Spence. So the first thing to note is we are a bit constrained in what we can say about Santos. So we're currently in litigation in front of the federal court regarding historic disclosures that Santos has made around climate change. So our allegations are that Santos misled or deceived investors around statements that they have a clear and credible path to deliver their 2040 net zero commitment, that it's capable of producing or it will produce zero emissions hydrogen, and that gas is a clean fuel. So while this is before the court, we're restricted in what we can say, but we are hoping and expecting a trial has been confirmed for October this year. So hopefully the case will come to a close and we won't be facing these restrictions for much longer. So in summary, our views on Keith Spence. He's chaired the board since 2018, and under his tenure, he's failed to deliver a company strategy that maximises shareholder value. So in 2021, crystallised with the FID of Barossa, Santos has gone from a low-cost operating model to a high capex growth mode, and performance against peers and indices has dramatically underperformed since then. The company knows it has a problem with the CEO admitting that the share price is stalled. But the board doesn't seem to have many options aside from the sale of part or all of the company. There's a series of other governance failings which Harriet will deal. And as the chair of the Santos board, we do see Mr. Spence as responsible for the company's performance. So this is the quote from Mr. Gallagher, the Santos CEO. So he expressed at the investor briefing day recently that a frustration with the share price. So in his view, the Santos share price is stalled and they need to unstall it. When we look at where that comes from, so this is the total shareholder return of Santos and a bunch of international peers, as well as Woodside, from the FID of Barossa in 30th of March 2021 through to the end of last calendar year. So over that period, Santos delivered 7%. Which is massively below the peers, less than or more than 90% below that peer group of 82, well below the MSCI World Energy Index, and also well below the ASX 200 and the 100 as well. In some ways, that wasn't unforeseeable. In fact, in some ways, it was foreseen. So a few years before the Santos, so the Barossa FID, Kevin Gallagher at a previous investor day said that the industry has a habit of blowing themselves up when they go into growth mode. So he put a huge amount of effort into reducing cost and constraining capital, and that was paying dividends. And he was clear at the time that he didn't want to sacrifice those gains. And if we have a look at the data behind that, so in the 9 years before Mr. Gallagher became CEO, capex was over $2 billion per year, driven in part by the Gladstone LNG project. So the Gladstone LNG project was delivered well over budget. And it was late and eroded $1.5 billion of value, according to our analysis. So during that time, those 9 years, Santos delivered 10% annual returns below the World Energy Sector Index. When Mr. Gallagher came on board, he dramatically cut costs. Like, he cut capex by 69%. Like, it's absolutely huge. And he had this really laser-like focus on what he called repeatedly and persistently the disciplined low-cost operating model. So that completely turned around Santos's financial performance. And for those few years between his appointment and the FID of Barossa, Santos outperformed the MSCI World Energy Index by 20% per annum. So huge overperformance. So in response to our member statement that we filed, Santos included like a rebuttal effectively in the notice of meeting. One of the things they've included was a view of TSR, or cumulative total returns, during Mr. Spence's tenure. It took us a while to understand what this graph is showing. You know, when I first looked at it, I had a look at those x-axis labels, so 2019, 2020, 2021, and assumed that each pair of bars for the ASX Energy Index and Santos referred to 12 months. That's not actually what it shows. What this graph is showing, after we've unpacked it, great work by Isaac, is that that first pair of bars refers to the 12 months in 2019. The second pair of bars refers to the 24 months in 2019 and 22. So as you go from left to right to this graph, the period that these bars are representing is increasing. You know, the effect of that was to conceal the company's performance over time. And when you unpack it, you see in that first year of 2019, there was really strong performance from Santos. So we attribute that to the strategy that was in place when Mr. Spence became the chair, rather than decisions that he made as the chair. So when you split up that data and compare it to other indices, so you know, our first set of columns there is Santos in purple, delivering that 54% return, and then three other indices, so ASX 200, ASX 200 Energy, and the MSCI World Energy Sector. Santos did fairly dramatically outperform those indices in that first year of Mr. Spence's tenure. But since then, including the pivot to growth with the Barossa FID, Santos has delivered 4% over 4 years. So, you know, dramatic underperformance against all of those indices. This reflects the decisions that have been made under his tenure, as opposed to the business model that was in place. So when he became the chair. We also challenged the use of the ASX Energy Index as a useful benchmark. So, you know, more than half of that index is made up by two companies, with Santos being one of those and Woodside the other. Of the other 7 companies, there's a broad range of sectors, including uranium mining, oil refining, oil retailing, and there's only one other upstream oil and gas company, which is Beach. So a big portion of that index is either Santos itself or companies which we don't think are the best peer, can make the best peer comparisons. So Santos has pivoted to growth, and this is supported by the assumptions that it's make. So the assumptions it holds. So its oil price assumption is much higher than peers. So this is the same peer group that we used for the TSR comparison, which is a bunch of international super majors as well as Woodside. Of this group, Santos has the equal highest price. So Equinor just this year increased its price to match Santos. Before that, Santos had clearly higher assumptions than any of these other companies, and 22% above the market. So having assumptions that oil prices will be higher than the rest of the market assumes is consistent with a continued growth strategy. We also noted in our member statement that Santos does not appear to have disclosed a hurdle rate. Santos's response in the notice of meeting was that they disclose a ROACE target. So in our view, a ROACE target is not an investment hurdle rate because it isn't a tool used regarding the allocation of capital to specific investments. And I'll hand over to Harriet to talk to some of the governance concerns and directives.
Thank you, Alex. Happy to give you a little breather before your next session. So we think it is really important to look at the remuneration settings at Santos to better understand what is behind the share price performance when the growth pivot was initiated, or since the growth pivot was initiated. So in April 2021, a growth projects incentive was announced for CEO Kevin Gallagher. It was 2 weeks after the Barossa FID. And when it was announced, a number of governance experts, including Vasily Kalashnikov from ISS, spoke out about their sort of concerns with that incentive, particularly the fact that it was an incentive to deliver on future projects that are not, guaranteed to deliver earnings and value for shareholders. And the concern was that Mr. Gallagher would get that incentive even if strong outcomes for shareholders were not delivered. The Australian Shareholders Association concurred with that concern and highlighted in their questioning of the chair at the AGM that year that they were concerned about an absence of a hurdle to ensure that shareholders had a really good outcome with that incentive. So it is our view that there's a really clear link between this growth project's incentive and Santos's share price performance. And that by approving an incentive that doesn't have a really clear link with shareholder returns, Santos shareholders are now paying for that. We highlighted this in our members' statement, and in Santos's response to the statement in the notice of meeting, it didn't really address this primary concern about the absence of the value linkage in the bonus. They just had quite a lot of verbiage on the linkage of sustainability metrics to the remuneration scheme. You know, in general, we think that is a good thing, but it sort of stood out to us that the company did not address the primary concern that we highlighted in our statement. So in continuation of the governance concerns, we do have questions around whether the Santos board, chaired by Keith Spence, is capable of holding management to account. I think it's really important to be mindful of the long-term partnership between Kevin Gallagher and Keith Spence. They've worked together over essentially 3 companies for about 20 years. So that's Woodside, Clough and Santos. I should emphasise that this snapshot is not our work. This was produced by Snowcap in the slide deck that they produced on Santos this time last year. We've got a few examples here that highlight sort of some concerning decisions or perhaps lack of oversight from the board. One sort of pertinent example was when it was announced in January 2022 that Kevin Gallagher would be joining the board of Mineral Resources. Very unusual for a CEO of an ASX-listed company to join the board of another ASX-listed company. But particularly the timing was quite extraordinary. So that was at that time, Santos was in the midst of its merger with Oil Search, and you know, shareholders rightly expected that Mr. Gallagher's time and focus would be spent on executing that merger, rather than turning his attention to another company. But in addition, Mineral Resources does have some gas interests, so there are some sort of, you know, potential. There were some potential business conflicts as well at that company. So the initial announcement was made that he would be joining the board in January of 2022. In February of 2022, there was a fair bit of outcry from investors in the financial press, and by March of 2022, it was announced that Mr. Gallagher would no longer be joining the board of Mineral Resources. So it's good that that situation was rectified, but it is notable that that decision was made and approved by the board, of which Keith Spence was chair at the time. Another example that came to light at the end of last year was the board's approval for the leasing of a $3.3 million lease of a private jet for use by the CEO and the board. It's notable that this was not disclosed to shareholders in any reporting. It was uncovered by the media. There was possibly a leak to media. It's sort of quite at odds with sort of standard practice in corporate Australia. You know, various commentators observed that not even the CEOs of BHP or Rio Tinto are flying around in private jets. But for some reason, the Santos board approved this for their CEO. And it was in various articles relating to the development, you know, it was noted that to be a terrible look by unnamed institutional investors. We also note that this additional kind of benefit for the CEO was not included in the 2023 remuneration report. And finally, there has been a pretty sort of persistent theme of staff satisfaction being quite low, staff satisfaction with management being quite low at Santos. This came to light initially through a 2021 survey where, you know, there was very low scores for questions around trust in leadership. I think Alex is certainly quite connected with a number of Santos staff members, and certainly anecdotally, this is reinforced in his conversations. There's also the Glassdoor website, which we are conscious it's sort of a case of, employees self-reporting their experience at different companies. It is not peer-reviewed data, so, it needs to be taken with a bit of a grain of salt. But it is notable that the CEO's score on the Glassdoor website, has been very low, and as low as 23%. And that becomes a bit more meaningful when you observe the equivalent scores for his peers at Woodside, Origin, and AGL, which are all sitting sort of above 88%. And I guess the question there is, is the board fully aware of this situation and the Santos staff sort of experience under management, and are they willing to really rectify the situation? And this is the last slide from me before Alex starts talking to our research, but we just wanted to highlight that there are actually 4 directors that are facing election or re-election at the 2024 AGM. So the other incumbent director that is facing re-election is Vanessa Guthrie. And while we are firmly of the view that it is the chair's ultimate responsibility, the underperformance issues that we've been discussing are the chair's ultimate responsibility, the whole board shares this, particularly board members that have been on the board for the duration of leading up to and the execution of the growth pivot, and that certainly is the case for Vanessa Guthrie. So we will be voting against Vanessa Guthrie as well. And we just also note that she is has a number of additional commitments, both as an ASX director and outside the ASX. So there may be some questions around overboarding for her as well. The other piece of information that emerged in the notice of meeting, so we had heard that there was some board renewal activity happening at Santos, and the outcomes of that were announced in the notice of meeting, with Peter Hurl and Eileen Doyle retiring from the board, and 2 new appointees being nominated. The one being Vicky McFadden. She's an experienced director on the ASX. She's a chair at GPT, non-executive director at Allianz Australia. We have no particular concerns or questions around Vicky's appointment. Sort of from the outside, it kind of makes sense. But also note that we have not sought a meeting with her to sort of get a better understanding of her views and of the sort of forward opportunities and potential strategies for Santos. The other candidate that was nominated was a name and profile that stood out to us quite a lot, and that is John Lydon. It appears that through the bio that has accompanied his nomination, it does appear that he is being positioned as a sort of climate or transition candidate, which understandably piqued ACCR's interest. We did seek to meet with Mr. Lydon to get a better understanding of his, what he sees as the opportunities and risks for Santos. He declined the opportunity to meet with us, which was a shame. I will just highlight that the key sort of climate credential that is listed for Mr. Lydon is his role as a co-chair of the Climate Leaders Coalition, which is a B Corp-led initiative. It's comprised of a large number of corporates that are members across the country. It's an initiative that ACCR has sort of had its eye on for some time. I guess we've had some concerns around its sort of branding as being a forum for leadership, and then looking at its membership and seeing that the likes of Woodside and Santos are members. And we have separately sought to meet with the Climate Leaders Coalition to sort of, have a more sort of direct discussion around those concerns, but that opportunity has not been available to us. So I guess just to conclude, I'd probably say that if you do get an opportunity to meet with Mr. Lydon, we would certainly encourage you to sort of ask questions around his transition and climate credentials, to satisfy yourselves that he is bringing really skills that are of value and that are really credible to the board of Santos.
Thank you, Harriet. The last few slides we have to cover relate to some new research that ACCR put out recently. So this looks at Santos's recent strategy and its capex-heavy production growth strategy in particular. So we note that the gas industry is entering structural decline, and we think there's serious questions to ask about what the optimal strategy is from here on in, and we think there are options other than what Santos is progressing. So report Santos growth strategy, will it deliver for shareholders, has been published. So what the key findings are is that, the look back over 30 years, part of which has been in this presentation, is that Santos's total shareholder returns have not been positively correlated with production growth or with periods of high capex spend. We did an asset level analysis of the projects that Santos is targeting FID for by 2025, and we found that they're not Paris aligned and they're not low cost even compared to other projects globally which are not Paris aligned. We assessed a share buyback alternative strategy and found that it generates more value than executing those 3 projects while reducing risk and avoiding significant emissions. We also looked at the potential benefits of ceasing all fossil fuel development in Santos's portfolio, and have some estimates of how significant that upside is. So working through those, so like I said, the TSR we've largely covered already. The NPV of these 3 projects. So these 3 projects, Narrabri, Papua LNG and Dorado, have a combined capex of over $6 billion. So that's Santos share US dollars. But the NPV of those, if delivered to plan, is under $1 billion, so just over $800 million. So that's 5% of market cap. So these projects would take years to implement, and Santos is consuming its reserves faster than 5% per annum. So this, even if they are developed, they wouldn't generate a lot of money. They have a high capex risk, and they wouldn't prevent Santos's becoming a smaller company. The emissions associated with these are 136 million tonnes. Again, that's Santos share, and significantly higher if you include the joint venture partner share of each of these projects. When we look at an alternative strategy, so we've assessed an alternative strategy of share buybacks, and what we found is instead of the $800 million of delivering these projects and executing these projects if they go to plan, there's $1.5 billion of potential upside. So more than $700 million higher value to not deliver these projects and to instead reallocate that $6 billion of capital to share buybacks. Obviously, if you don't execute projects, there's entire categories of risk, such as greenfields execution risk that just aren't part of the portfolio anymore, and there's significantly fewer emissions. So even before you think about that, the high value of those, or the upside of that share buyback, there's a range of risks that not executing these projects can avoid. So Papua LNG, for example, is targeting a startup in 2028, when the IEA says that under all of their scenarios, there's going to be a significant LNG supply glut. So there's market pricing risk, there's significant above ground risk in Papua LNG. Dorado and Narrabri, the 2 Australian projects, also appear to offer mediocre returns and are struggling to progress. So we're not seeing much evidence that those projects are likely to be executed, but we don't see a lot of upside even if they are. So when you step back a little bit and think about what a business like Santos would look like if it wasn't developing fossil fuel projects, we see a number of significant upsides. Have to be clear, the analysis behind these numbers is higher level and much less specific than the project-specific analysis, but we still think that there's significant quantifiable upside. So the 3 categories we've looked at is one is avoiding exploration costs. So that $1 billion there is it's out of Rystad data, and it's just the capitalized historic cost of the exploration expense that Santos has incurred, where it hasn't resulted in a discovery. So that's an annualized cost of exploration, which is not does not appear to be presenting any development opportunity at all. If you considered the development the exploration that has been successful, that number would roughly double. As I've mentioned, if you cease developing fossil fuel projects, there's significant risks which are no longer part of your portfolio, and the free cash flow becomes much more stable. So for a company of Santos's size, each of these major projects has a material impact on free cash flow. Like, it doesn't average out because there's such lumpy investments. And so with more stable and less volatile free cash flow, it's a lower risk business. We estimated the impact of that by assuming that Santos could increase its gearing from its current 20% target up to 25%. So that, and then we applied that lower discount rate, or the lower weighted average cost of capital, to its operating and sanctioned portfolio, and found there's $500 million worth of upside there. Also, if you don't need to develop new fossil fuel projects, then you can have a simpler and leaner organisation with fewer staff and associated overheads. So we've assumed a 5% reduction in headcount with, and then capitalised that amount and found there's another $200 million of savings. Arguably, these costs are a bit conservative, but if you read through the report, you can see our assumptions, and it's probably simple enough analysis that you could run your own sensitivities. So we encourage you to have a look at that detailed research if you get a chance to. So stepping back a bit, to summarise our voting intentions for this year's AGM. So for the re-election of Mr. Spence, we're going to be voting against him. Because during his tenure, he's pivoted, or Santos has pivoted to a high capex growth model, and has since chronically underperformed its peers and several market indices. There's been a series of governance issues, principally the executive bonus structure. It doesn't have, which rewards growth without a clear linkage to shareholder returns. We see the chair as responsible for the company's decisions made under his tenure, and he should be held accountable. Our research shows that there is an alternative, higher value, lower risk strategy that Santos could be implementing, but that we don't see any evidence that Santos has been considering this type of strategy. So that concludes the presentation. I'll pass back to Gemma for Q&A.
Thanks, Alex. If you have questions, now is the time to pop them in the box. I guess, maybe we can start by just covering a couple of things that investors have raised as we have spoken about this along the way over the last month or so. Harriet, I think one thing that has come up in discussion is, if the chair was voted off, is this actually, a good outcome? And that's a pretty big deal. Like, what's your response to the chair actually being voted off?
Thanks, Gemma. Yeah, it is a big deal. I think we have to remember that the board selects the chair rather than shareholders. And so in a scenario where Keith Spence was to be voted off, I guess we would argue, succession planning is a responsibility of a chair. He is the chair of the nominations committee. So if there genuinely was not a suitable alternative candidate to be elected as chair by the rest of the board, then we would argue that just reinforces our concerns around Mr. Spence's performance as chair of the company.
I guess one more thing while we wait for any other questions to come through. I think one thing that has been raised by investors is in the annual results call, Alex, Mr. Gallagher indicated that capex will decline from 2025 once Barossa and Pica sort of big capex spend phases are complete. What's your view on that?
So yeah, any greenfields project is going to have a hump of capex spend. So inevitably, capex on those projects will decline. If that is the start of the end of a capex-heavy growth model, then that's exactly what we're advocating and recommending, and what our analysis supports. So we'd see that as a positive step. But when you look back over the last 30 years of Santos, these periods of low capex spend haven't been sustained, and we think it's in the culture of the company, in the DNA of the company, that it will get itchy feet again, and it will, it'll be tough for it to maintain that discipline over an extended period of time. And we just come back to the fact that, the chair came in to and became the chair of a company that was constraining its capex, and he supported and oversaw the pivot to a high capex business model, which has destroyed or eroded a lot of value. So we still think the chair is responsible for those decisions that have been made under his tenure.
I don't think we've had any other questions pop up in the chat. So look, if I just want to say, if anyone would like to reach out to us to ask a question or to discuss anything that we presented today, please do. We are around over the next few weeks and we are available for chats if anyone does want to sort of discuss anything in more detail. So thank you for taking the time to listen today, and yeah, have a wonderful day. I hope it's a good one.